A lot of people hear the term cash secured put and immediately think it sounds complicated. It's not. In plain English, a cash secured put is just this. You agree to buy a stock at a specific price if it falls to that level by a certain date, and in exchange for making that promise, you get paid cash up front. That's it. So let's use the real example from the CMG options chain. At the time of the screenshot, Chipotle Mexican Grill CMG was trading at $37.35. Looking at the March 6th, 2026 weekly options, the $35 put was showing a 25-cent bid and a 35-cent ask, with the last trade at 33 cents. So let's say you step in and sell that put for around 30 cents. Now, what have you actually done? You've told the market, I'm willing to buy 100 shares of CMG at $35 per share anytime up to expiration if the stock is below that level. For making that promise, you collect 30 cents per share, or $30 total on one options contract. Because each standard options contract controls 100 shares, you're not dealing with tiny numbers here. If you get assigned, you'll be buying 100 shares at $35, which means you need to have $3,500 in cash sitting in the account. That's the cash secured part. You're not just making a promise in the air, you've actually got the money set aside to buy the stock. So why would anyone do this? Because it gives you two possible ways to win. The first outcome is the easy one. If CMG stays above $35 through expiration, the put expires worthless. Nobody is going to force you to buy the stock at $35 if the market price is still higher than that. In that case, you simply keep the $30 premium and move on. Not bad. You didn't buy the stock. You didn't need CMG to rally. You just got paid for being willing to buy it lower. The second outcome is that CMG drops below $35. Now you may be assigned, which means you'll have to buy the shares at the strike price you agreed to. Let's say CMG closes at $34 at expiration. You'll still buy the stock at $35, even though the market says it's only worth $34 at that moment. At first glance, that sounds like a loss. And yes, technically it is. You're paying $1 more per share than the current market price. But don't forget the premium. You already collected 30 cents per share when you sold the put. So your true cost basis isn't $35. It's really $35 minus 30 cents equals $34.70. That's your break even. This is the number that matters. If CMG is above $34.70, you're ahead. If it's below $34.70, you're down on the trade. That's why cash secured puts can make sense for investors who already want to own the stock at a lower price. You're basically saying, I'd be happy to buy CMG, just not at $37.35. I'd rather buy it at an effective price closer to $34.70. And if I don't get the shares, at least I get paid while I wait. Now let's talk about the risk, because this is where people get lazy. The premium looks nice, the trade feels conservative, and most of the time these trades can work out just fine. But the real risk is not a small dip. The real risk is a hard drop. If CMG falls to $30, you're still obligated to buy at $35. Sure, you collected 30 cents up front, so your real basis is $34.70. But if the stock is sitting at $30, you're still down. $34.70 minus $30 equals $4.70 per share. That's a $470 loss on one contract. And that's the part traders need to respect. You collect a small premium in exchange for taking on downside risk. The premium cushions the blow a little bit, but it does not save you if the stock really breaks down. So a cash secured put is not free money. It's a paid agreement to buy stock lower. That can be a smart move when you want the shares anyway and you're comfortable owning them. It can be a dumb move when you chase premium on a stock you don't actually want to hold. That's the key. If you sell the CMG $35 put, you should be perfectly fine waking up and owning 100 shares of CMG at an effective basis of about $34.70. If you're not okay with that, then you probably shouldn't be making the trade. So let's put a bow on it. With CMG trading at $37.35, selling the March 6th, 2026 $35 put for about 30 cents means you collect $30 up front. You set aside $3,500 in cash. You agree to buy 100 shares of CMG if the stock falls below $35, and your real break-even price is about $34.70. Best case, the option expires worthless and you keep the premium. Middle case, you buy the stock at a discount to today's price. Worst case, the stock falls hard and you're sitting on a loss, just like any other stock owner would be. That's a cash-secured put. Simple trade, real risk, solid tool if you use it the right way. If you want the complete breakdown, download our free options report below. Everything discussed here is our opinion and is not to be taken as investment advice, nor have we considered your personal situation as your fiduciary. This presentation is for education and entertainment only. Please review NetPick's full risk disclaimer and privacy policy.